Introducing the concept of FOMO. In the ever-evolving landscape of finance, where fortunes can be made or lost in the blink of an eye, understanding the intricate workings of the human psyche is as crucial as deciphering market trends and economic indicators. One such psychological phenomenon that has garnered increasing attention in recent years is FOMO, fear of missing out. Originating from the realm of social psychology, FOMO has transcended its initial confines to permeate the financial sector, exerting a profound influence on investor behavior and market dynamics. This comprehensive exploration aims to delve into the multifaceted nature of FOMO, tracing its origins, dissecting its impact on financial markets, and elucidating strategies to cope with its effects. Origins and definition of FOMO. The genesis of FOMO can be traced back to the dawn of the digital age, coinciding with the meteoric rise of social media platforms and the advent of real-time information dissemination. Initially conceptualized as the apprehension or unease experienced when perceiving others enjoying experiences or opportunities from which one is absent, FOMO has evolved to encompass a broader spectrum of emotions, particularly within the realm of finance. In the financial context, FOMO manifests as a visceral fear of missing out on profitable investment opportunities or lucrative market movements, fueled by the omnipresent barrage of market news, social media hype, and peer influence. FOMO in financial psychology. At its core, FOMO in finance is underpinned by fundamental psychological principles ingrained in the human psyche. The innate drive for social inclusion, coupled with the primal instinct for survival and prosperity, forms the bedrock upon which FOMO thrives. As social beings wired for connection and belonging, individuals are inherently susceptible to the allure of perceived opportunities for financial gain, often succumbing to the fear of being left behind in the pursuit of wealth accumulation. This primal fear, amplified by the dopamine-fueled reward circuitry of the brain, can precipitate impulsive decision-making and irrational behavior, leading to a cascade of market distortions and volatility. FOMO in the financial market. The annals of financial history are replete with instances where FOMO has wielded its formidable influence, leaving indelible imprints on market trajectories and investor psyche. From the dot-com bubble of the late 1990s, characterized by frenzied speculation in internet-related stocks driven by FOMO-induced euphoria, to the recent surge in cryptocurrency valuations fueled by a frenzy of retail investor participation, FOMO has been an omnipresent force shaping market dynamics. Notable examples such as the GameStop saga of early 2021 underscore the pivotal role of social media platforms in amplifying FOMO-driven investment frenzies, underscoring the potent interplay between technological innovation and human behavior in financial markets. Factors driving FOMO in financial investment. The proliferation of FOMO in financial markets can be attributed to a confluence of factors, each exerting its unique influence on investor sentiment and decision-making. Media and social media amplification. The advent of digital media and social networking platforms has democratized access to market information, enabling the rapid dissemination of investment trends and amplifying the impact of FOMO-induced herd behavior. Investment environment and social proof. Economic conditions, coupled with social proof mechanisms, play a pivotal role in exacerbating FOMO-driven investment behavior. During periods of economic expansion or in the wake of perceived success stories shared within social circles, individuals are more susceptible to the allure of FOMO-induced investment euphoria. Monetary policy and economic stimulus. Central bank policies, characterized by low interest rates and quantitative easing measures, can exacerbate FOMO by incentivizing risk-taking behavior in search of higher yields. Loose monetary conditions, coupled with fiscal stimulus measures, create an environment conducive to speculative excesses, thereby fostering FOMO-driven investment manias. Consequences of FOMO in financial investment. The ramifications of FOMO in financial markets are manifold, spanning short-term market distortions to long-term investment risks. Short-term volatility and speculative bubbles. FOMO-induced buying frenzies can precipitate short-term market volatility, characterized by erratic price movements and heightened uncertainty. In extreme cases, FOMO-driven speculation can inflate asset valuations beyond their intrinsic worth, culminating in the formation of speculative bubbles poised for inevitable correction. Long-term investment implications. The insidious effects of FOMO extend beyond transient market fluctuations, permeating the fabric of long-term investment strategies. Investors ensnared by FOMO-induced euphoria may deviate from sound investment principles, forsaking prudence in favor of speculative excesses, thereby exposing themselves to heightened risks and potential losses. Coping strategies for FOMO and financial investment. In navigating the treacherous waters of financial markets fraught with FOMO-induced pitfalls, investors can adopt a multifaceted approach to mitigate its pernicious effects. Cultivate discernment and rationality, anchor investment decisions in rigorous analysis and disciplined decision-making, eschewing the temptation to succumb to FOMO-induced impulses. Embrace a contrarian mindset, viewing market euphoria with skepticism and maintaining a steadfast commitment to long-term investment objectives. Embrace diversification and risk management. Construct well-diversified investment portfolios tailored to individual risk preferences, incorporating risk management techniques such as asset allocation, stop-loss orders, and portfolio rebalancing. By spreading investment exposure across diverse asset classes and geographies, investors can fortify their portfolios against the vagaries of FOMO-induced market volatility. Continuous education and self-awareness. Cultivate a thirst for knowledge and a robust understanding of market dynamics through continuous education and engagement with reputable sources of financial information. Foster self-awareness and emotional resilience, recognizing and mitigating the psychological biases that underpin FOMO-induced decision-making. Conclusion. In conclusion, FOMO represents a formidable psychological force that permeates the intricate tapestry of financial markets, exerting a profound influence on investor behavior and market outcomes. By unraveling the complexities of FOMO, understanding its origins, and devising strategies to cope with its effects, investors can navigate the choppy waters of financial markets with greater resilience and clarity of purpose. Armed with discernment, diversification, and a steadfast commitment to rational decision-making, investors can transcend the grip of FOMO-induced impulses and pursue their long-term financial objectives with confidence and conviction.